The market is in freefall. Trump's sweeping tariff announcement on April 2nd has wiped out over $1 trillion in market value overnight. But while most investors are panicking, history tells us that this chaos isn't just a crisis, it's potentially the wealth creation opportunity of a decade. Every major market disruption has created a new generation of millionaires who saw opportunity where others saw disaster. After the 2008 crash, investors who bought quality stocks at fire sale prices saw 5x, 10x, even 20x returns in the years that followed. During the COVID crash, those who invested in tech when everyone else was selling created generational wealth in months. And now, as the 2025 tariff crash unfolds, similar wealth-building opportunities are emerging for contrarian investors willing to act while others freeze in fear. In this video, I'll show you exactly where to look for the companies that could lead to extraordinary gains as markets eventually recover. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. The psychology behind market crashes and why they create extraordinary wealth-building opportunities. Historical examples of contrarian investors who became millionaires by buying during major market panics. Specific sectors getting crushed by the tariff announcement that could represent massive upside potential. How to identify the strongest companies within those beaten-down sectors. The key metrics and signals that separate potential multi-baggers from value traps. And of course, my watch list of potentially undervalued stocks that could create substantial wealth in this market environment. Understanding the 2025 tariff crash. To understand the opportunity before us, we need to grasp what's happening. On April 2, 2025, President Trump announced sweeping new import tariffs. A baseline 10% duty on all U.S. imports with much steeper rates for major trading partners. China faces a 34% tariff, the European Union 20%, Japan 24%, and Vietnam a staggering 46%. There are 115 countries on the tariff list that actually buy more from the U.S. than they sell to us, yet they still got hit with a 10% tariff. These tariffs represent the highest effective U.S. import tax rates since around 1910, according to Fitch Ratings. The market reaction was swift and brutal. The S&P 500 futures pointed to a 3% drop, the Dow indicated a 1,000-point plunge, and Apple alone lost over $240 billion in market value after hours. Tech stocks with global supply chains were hit particularly hard, with the Nasdaq futures falling nearly 2.4% while Trump was still speaking. China has already announced retaliatory 34% tariffs on all U.S. goods. This panic selling makes perfect sense. The new tariffs threaten to disrupt global supply chains, increase costs for companies that rely on imported components, potentially trigger retaliatory measures from trading partners, and possibly push the economy toward stagflation, a toxic mix of rising prices and slowing growth. A study from the National Bureau of Economic Research found that the costs of President Trump's trade war in 2018 were passed entirely onto importers and consumers, leading to lower spending, lower earnings for companies, and ultimately lower stock prices. But here's where contrarians see opportunity. Market crashes driven by macro news typically create indiscriminate selling. Good companies get punished alongside vulnerable ones. Strong businesses with temporary headwinds see their stocks collapse alongside fundamentally broken ones. This disconnect between price and value is where the greatest investment opportunities emerge. History shows a consistent pattern. Market panics create extraordinary buying opportunities for those with the courage to act. Bull markets typically last 4.3 years, with average returns of 150%, while bear markets last just 11 months with average drops of 32%. Simply put, upswings last longer and rise higher than downturns. The contrarian playbook is written in market history. During the 2008 crisis, Buffett invested $5 billion in Goldman Sachs when banking seemed on the verge of collapse, eventually yielding over $3 billion profit. In 2009, David Tepper purchased bank stocks at pennies on the dollar. Citigroup debt at 19 cents, Bank of America preferred shares at 12 cents, generating 132% returns and $7 billion in profits. During the 2020 COVID crash, Bill Ackman turned a $27 million hedge into $2.6 billion and used those proceeds to buy stocks at March lows. Even the 2018 tariff tensions, when Trump imposed steel and aluminum tariffs, created opportunities. The market dropped nearly 20% in Q4 2018 before rebounding significantly in 2019. The data is clear. Companies that survive major market dislocations often deliver returns of 100 to 500% in the subsequent 3 to 5 years. These crashes create asymmetric opportunities where potential upside vastly exceeds downside risk, precisely the kind of setup we're seeing now with the 2025 tariff situation. Sectors under pressure. Trump's tariff announcement has created targeted pressure across several key sectors, creating a landscape of both risk and opportunity. The hardest hit sectors include technology. Global supply chain exposure led to immediate sell-offs. Apple, 7%, Nvidia, 5.6%, as investors priced in higher component costs and potential Chinese retaliation. Industrials and manufacturing. Companies facing higher input costs for steel, aluminum, and auto components are particularly vulnerable to margin compression. Consumer discretionary. Retailers sourcing from Asia face the choice between absorbing costs, hurting margins, or raising prices, potentially hurting demand. Semiconductors. Uniquely vulnerable due to globalized supply chains, with designers in the US but manufacturing primarily in Asia. Meanwhile, defensive sectors like consumer staples, healthcare, utilities, and domestic energy producers show relative strength due to pricing power, inelastic demand, domestic operations, or potential policy benefits. This sector disparity creates the perfect contrarian setup, targeting high-quality companies in the hardest-hit sectors that have been indiscriminately sold, despite having strong balance sheets, adaptable business models, and the ability to weather temporary disruptions. Finding the strongest stocks in weak sectors. The greatest opportunities lie in identifying companies that have been disproportionately punished relative to their actual tariff exposure, possess the financial strength to navigate higher costs and supply chain disruptions, maintain competitive advantages that allow them to adapt and potentially benefit as weaker competitors struggle. Let me break down my approach to finding these opportunities. Financial strength indicators. Low debt-to-equity ratios, preferably under 0.5. Strong free cash flow generation, FCF margin 10%. High interest coverage ratios, 5x. Significant cash reserves relative to market cap and operating expenses. Competitive positioning factors. Market leadership positions, top 1 to 3 in their category. Pricing power demonstrated in previous inflationary periods. Geographic diversification of manufacturing and sales. History of successful navigation through previous trade disputes. Intellectual property or brand strength that creates customer loyalty. Valuation metrics. Forward PE ratios at multi-year lows. EV/EBITDA below 5-year averages by at least 20%. Price-to-free cash flow ratios near historical floors. Price-to-book values approaching tangible asset values. Using these criteria, I've identified several potential opportunities within the hardest-hit sectors. In technology, Google's earnings estimates tend to be consistently on the low side. Analysts expect 10% earnings growth, but Google's earnings grew by 36% last year and 27% the year before. Similarly, Meta has seen its valuation compressed despite growing earnings at more than double the rate analysts project, especially since they reduced their spending on the metaverse. Within industrials, defense contractors with primarily domestic operations and long-term government contracts provide stability even if other industrial segments struggle. Several have fallen 15 to 20% simply due to sector association. In consumer discretionary, certain U.S. retailers with established domestic supply chains or the ability to quickly diversify sourcing have declined alongside those heavily dependent on Chinese manufacturing, creating potential opportunities. Semiconductors present perhaps the most interesting case. While the sector faces real challenges with Trump threatening tariffs as high as 25% on foreign chip makers, this appears to be more of a tactic to pressure companies like TSMC into building more factories on U.S. soil rather than a serious long-term tariff. TSMC makes 90% of all advanced chips on Earth, including Apple's chips, Tesla's self-driving technology, and Nvidia's GPUs, giving it a critical position in the global tech ecosystem that's unlikely to be disrupted long-term. Not all beaten-down stocks represent opportunities. To separate potential winners from likely losers, watch for these red flags. High debt loads with near-term maturities, pre-existing margin compression, limited pricing power in commoditized markets, prior supply chain warnings, high exposure to retaliatory tariffs. To avoid catching a falling knife, consider these strategies. 1. Scale in gradually rather than all at once. 2. Establish specific valuation triggers for additional investment. 3. Track insider buying as a confidence signal. 4. Monitor bond prices for early warnings. And 5. Watch institutional fund flows for bottoming signals. As Buffett wisely noted, be fearful when others are greedy, and greedy when others are fearful. This doesn't mean buying indiscriminately during panic, but rather making selective investments in quality assets at temporarily distressed prices. If you're finding value in this analysis of contrarian opportunities in the current market environment, I'd really appreciate your support with a like on this video. Your engagement helps more investors discover this research during these challenging market conditions. And if you want to stay updated on how these contrarian opportunities develop as the tariff situation evolves, consider subscribing to the channel. The April 2nd tariff announcement has created the kind of market panic that historically produces exceptional investment opportunities. With the CNN Fear and Greed Index at extreme fear levels, the lowest reading in a year, contrarian investors with longer time horizons face a favorable risk-reward proposition. As Baron Rothschild advised during the panic after Waterloo, buy when there's blood in the streets, even if the blood is your own. Several high-quality companies now trade at valuations that seemed impossible just weeks ago. While volatility will continue as companies adjust to the new tariff regime, this uncertainty creates opportunities for those prepared to act, while others remain paralyzed by fear. 5 years from now, I believe we'll recognize this period as one of those rare windows where extraordinary returns were available to investors willing to embrace short-term discomfort for long-term gain. Leave a comment with stocks you'd like me to cover, and I'll select the most requested ones for thorough analysis. Thanks for watching to the end. Until next time, this is Harry reminding you that the best investment you can make is in you.